Good afternoon, folks, or good morning, wherever you may be, and welcome to our Mailer Sub webinar for today. We have the honor of two of our finest legal minds joining us from Brandon Isaacson, Marty Eisenstein, and Jamie Zoll, who is dressed for the occasion today. And so,
And that came after Jamie's name, not after Marty Eisenstein's name. Please note
that's
that.
right. So they'll be talking to us about some tax issues. First, we want to point out that Mailer Hub is the only national organization serving commercial mail producers, whether you're a printer or a mailer, and we provide all kinds of information, training, and support to the community, including, as you can see, not just postal stuff, but also tax issues that involve our community. So if anybody would like to have more information about joining, there's the information. And I may point out to you that if you are a subscriber, our friends at Brandon Isaacson will give you, as we call it, the happy discount coupon. So and they will help you work through your problems. And there's the information that's popping into your chat box right now about how to contact them. So without any further ado, I will turn it over to Jamie and Marty first, then Jamie.
Thank you. So the title of this webinar indicates that we're focused solely on state corporate income tax. We had previously, Jamie and I have presented in the past, 95% of which was on sales tax. Now we're presenting on income tax because income tax is, believe it or not, a hot issue in state tax law, and it'll become even hotter of an issue as the big, beautiful bill wends its way through and states are uh, looking for additional sources of funds. So if we could go to the first slide. Thank you, Michelle. So we're going to cover three topics. It is my rule of three, never do more than three things in any one instance. And so the first topic is Nexus and Public Law 86-272. I'm going to present on that. And Nexus simply means when a company is subject to another state's income tax. Jamie's going to talk about how states split up the pie, so to speak. And then both Jamie and I will speak about planning. But the one thing that I want you to keep in mind is there is a myth that I've heard among very senior executives, both financial and operating the company, about state corporate income tax. If I pay it to one state, doesn't matter, I'll get a credit in my home state. Not true. Not true at all. And if you have that myth, then you should really listen closely to this webinar and ask questions. So we'll have 40 minutes of presentation, and hopefully we'll keep to that schedule, and then 20 minutes of Q&As, and we can field any other questions you have at a later time. So if you could go to the next slide, please. This is fairly fundamental. What does Nexus mean? It's a connection between the printer or producer and the state or city. Both states and cities have income taxes, although it's not common that a city has an income tax. Obviously, New York City has an income tax, and Philadelphia does as well, but most municipalities do not have their own income tax. It's a state income tax or state tax. If you could go to the next slide, please. So Nexus is really, uh, based upon one of two factors. One is a physical presence. Do you have an office or employees in the state? And the second is an economic presence. Is the volume of your revenue in the state uh, high enough? Please go to the next slide. On the economic presence nexus, it's whether the revenue crosses a certain threshold. It's normally an annual threshold. And if it's revenue alone is enough to trigger economic nexus. Fortunately, as we'll discuss, not every state has economic nexus. The unfortunate thing is that the high tax states like California and New York, and we're going to continue to go to that theme, do have economic nexus levels. So even if you never look at the state or touch the state with activities in the state, your company may still be subject to that state's income tax. Um, and
Marty, I want
so
to on that point for companies, it's fairly common among the states that the threshold for income tax purposes is different than the threshold for sales tax purposes. Often it's higher, but for example, you can see here on the slide, Washington and New Jersey, for those two states, it's the same threshold, a fairly low threshold at $100,000.
But for Ohio, as indicated on the slide, it's 6 mil. But please note that Washington and Ohio don't have an income tax. They have what's called a gross receipts tax. New Jersey does have an income tax, and it's an aggressive state, as we'll discuss later. And if we go to the next slide, you'll or 2 slides, but go to the next slide anyway. So for purposes of this law, Public Law 86-272, and we're going to speak a little bit about that, that protects, it's a federal statute that provides that an out-of-state company is not subject to another state's income tax if all that it does in a state is engage in the solicitation of the sale of tangible personal property. So the two factors or two aspects. First is that it doesn't provide protection for the Washington, Ohio, and other states' gross receipts taxes. There are only 6 states and a municipality, a couple of municipalities that have gross receipts taxes, and by and large, the states rely on income tax versus gross receipts tax for their source of revenues. Ohio, Texas, Washington rely on a gross receipts type tax. The second feature, which is a flashpoint in the states now, it's a hot issue, is that some states have narrowly interpreted Public Law 86-272, just happens to be the high tax rate states of California, New York, New Jersey, and Massachusetts, to say, even if you do only sales in the state, if you have a web or other kind, if you send credit cards in the state, if you only touch the state by mail or by the internet, you would still be subject to that state's income tax, despite the clear direction of Public Law 86-272. My firm has fought California and prevailed in part in that state. We're fighting New York, and we have a case on appeal to the New York Supreme Court, which is the appellate court in New York State, where we won on one issue and we're appealing another issue, and then there may be some litigation in the works in the great state of New Jersey. So it's not a given. It's an evolving area, and stay tuned. So the next slide, I think we turn it over to Jamie. Let me just say one thing, and this is the splitting up the pie, but it's not one pie that gets split up. The key in state income tax planning, as you'll probably hear from your accountants, tax preparers, is that you want to apportion less than 100% of your federal income. So you're not paying more than 100% of state tax, more than 100% of your income to states. And most companies have been successful in reducing that percentage to a smaller amount. So I'll turn the screen over to Jamie, and away you go, Jamie.
Great. Thanks, Marty. And certainly at the end of the presentation today, we'll get into some planning, I wouldn't say strategies, but questions for you to think about and discuss with your accountant or with Marty and me after the webinar, ways to think about how to strategically approach multi-state income tax. What we're talking about here is a company that may have a tax obligation in more than one state. And as Marty already said, it's different than federal income taxes. When you're paying tax to the IRS gets the whole pizza. When we're talking about state taxes, each state only gets its fair share of your income. And and it divides it up. It gets a slice, not the whole pizza. We're not talking about more than one flavor here. I'm a food person, so hope you don't mind. We're going to use some food analogies through this apportionment portion of the presentation here. And apportionment is the concept or the theory of how can a state or how can a company divide up its income among the states where it has nexus. As Marty said, if you don't have nexus, you don't have a tax obligation in the first place. So this portion, we're really talking about once a company has nexus, how much does it owe to that state? The states here on the slide, we're going to target, or not target, but talk about several of them. They're only for examples. There's many, many more states that have income taxes that put all together add up to hopefully less than 100%. It is possible that more than 100%, depending on how the rules apply, but that's partly what we're going to get to in this kind of planning end portion of the presentation, helping you hopefully avoid that outcome. What you may have gotten from us about state taxes in other presentations, and probably understand this already, is that states are like their own little mini territories. They all have their own rules. There is no uniformity, and they all of their rules kind of act at dissonance with one another. But there are some common themes through this that we'll take you through. All right, can we move on to the next slide, please?
And if I could just intervene,
Yeah.
I know Jamie likes food metaphors, but she just moved to Maine, so she's not using blueberry pie. Instead, she's using the pizza pie metaphor. So
you know,
I apologize for her lack of judgment.
I'm going to lose my Mainer card, and we're just about to hit blueberry season too. So I really should switch over to blueberry pie. You know, one morning in Maine and blueberries for Sal and all that as our theme for the day. So as I said, apportionment is the concept of how a company operates across that operates across state lines, whether that's because you have customers in other states, or you know, because you're printers, you make deliveries of mail to other states, you have revenue that can get sourced, meaning assigned a geographic location to somewhere other than where you have your production facility. There's two common formulas. We're talking about taxes after all, so these are math formulas here that we're talking about. And there's two common ones that are used to calculate each state's fair share of your income. Those two formulas are known as the three-factor formula. I think it's technically called the Massachusetts formula because after the state that came up with it in the first place, or the single sales factor formula. And the next couple slides will move into these two formulas in greater detail. The first benchmark, or the first thing to sort out with your accountant and with your internal team, is just what are the different formulas that apply in the states where you have business, because those formulas and how the states apply them are really going to drive how big or not, again, that slice of blueberry pie, each state gets to tax. So let's move on and dive into what these formulas are. We're going to start with the three-factor formula, the OG formula. I've been watching far too much television involving Gen Z these days, apparently. So this is the original formula that applies in state income taxes. And as you can see here, it is still in effect in a number of states. In the three-factor formula, states look at, all right, what is the value of your, or the ratio of your in-state payroll to total payroll? Total payroll means everything in the United States. And we're going to figure out what that ratio is. We're then going to look at the ratio of your property. What is in-state versus total? Now, this property could be property that you own. It can also be property that you rent or lease. So it's not just limited to owned property, but again, it's that ratio. And then lastly, it also includes a sales factor. What is the ratio of your in-state sales to total sales? The three-factor formula tended to work more favorably for companies that are based out of state, in large part because of a rule that every state who uses the three-factor formula has, which is that just because the numerator of your factor, payroll or property, is 0, does not mean that you get to eliminate the factor altogether. And because you have 0 plus some number for the sales, that has a dilutive factor for out-of-state companies. That's a really good thing for out-of-state companies trying to figure out, what does Alaska or Kansas or New Mexico get to tax of my income? You'll see among states that there's some variations or flavors of this three-factor formula as states have implemented it in their own way. Shocker, there's no very uniformity. Some states like Florida and Virginia decide to give the sales factor a little bit more weight. In fact, Massachusetts used to do this as well. They would double weight the sales factor, so that in that instance, you're looking at ratio of payroll, ratio of property, ratio of sales, and ratio of sales again, and divide the whole thing by 4 to get that average apportionment percentage. Tennessee is on its way to moving towards the single sales factor that we'll get to in a moment. And currently, because it's on its way to doing that, it weights the sales factor 11 times, right? It's trying to counteract the dilutive factor of payroll and property by giving the sales factor far more weight. Each time you add more sales factors to the formula, you're going to increase the denominator again, so that way you get the total average of all of these factors in order to calculate the state's apportionment percentage. I do want to say, in terms of what goes into the numerator versus the denominator, we'll get into some of those other rules in a few slides, but there is a difference between what a company's revenue is for purposes of like line 1 on your 1120 versus what counts as a sale for purposes of the sales factor. So again, the devil is in the details. You really need to go into the state statutes and read, all right, what counts as a sale in the first place? And then what are the rules for figuring out what goes in the numerator and what goes in the denominator? We're going to move on to the next slide, which is the single sales factor. This is the trending formula. More and more states are moving to the single sales factor formula, in large part because more and more states are really trying to capture revenue from out of state companies, and they realize having a single sales factor only as its apportionment percentage captures or a higher percentage of an out-of-state company's revenue than would otherwise be the case by including property and payroll. Their in-state businesses, of course, are happy about that move. But out-of-state companies, this really hits you a lot harder as states move to the single sales factor formula. So you can see here, there are a growing number of states, some as most recently as the 2024 tax year. And every year we see 1 or 2 states move to the single sales factor formula. I expect that the days of the 3-factor formula are very much numbered at this point, and more and more states are applying this. Let's move on to the next slide. All right, so as I said before, there are different rules that help you figure out how do you assign a geographic location to your revenue. Same thing with property and payroll, although those are easier to figure out. How do you do that? Well, it varies depending on what the underlying genesis of your revenue is. Are we talking about revenue from your print campaigns or your sales of other printed materials? Or are we talking about revenue from services? It does make a pretty significant difference in how the state applies its rules to assign a geographic location to that sale or to that revenue. Let's move on and dig into the details a little bit. When it comes to sales of tangible property, your print pieces, it's always going to be sourced to the delivery destination. This is typically a lot easier when we're talking about iPhones or, a standalone single item. For printers, this becomes challenging for the same reasons that it's really challenging on the sales tax side, which is that you're sending thousands of pieces of mail out in every print job. And under these apportionment rules, yes, that does mean you need to splice and dice your revenue from the print pieces among all of the different delivery destinations, not sourcing all of that revenue to the production facility location where you or your subcontractors may have produced that piece of mail. Services are much less clear-cut than sourcing tangible property. The operative phrase that we work in is where the benefit of the service is received. Well, just what does that mean? It's clear as mud, as sometimes we say, or clear as the blueberry filling in your blueberry pie. We're going to carry this analogy as we can. There are different ways to look at where a benefit is received for income tax purposes. You may have heard of some of these phrases: market sourcing, cost of performance. There's a third category here that we're going to get into a little bit as we go into some of the examples. And we highlighted them in a lot more detail in an article that we published in the Mailer Sub newsletter, 3 weeks ago or a month ago or so. We can, I think Michelle added the slides to the chat, but we can also relink the article as well. Market sourcing refers to the rule that states look to where your market as your seller, in many ways you think this as your customer, where is your customer located? And that's where your revenue from services gets apportioned to or sourced to. States are trying to get at kind of where is the customer base that's generating the revenue, on the theory that the customer is the one that is really paying you. Now, as you know, in the direct mail world, your customer is very different from the person who receives the end product of what you produce. And so there is a dissonance. We'll get to that in a moment. Cost of performance is the old rule, right? I should say market sourcing is the trending solution. More and more states are moving to that as the sourcing rule for services. Cost of performance is the original rule, however. In the cost of performance rule, or you might see this referred to as the income producing activity rule, states look at where a company incurred the direct costs for providing its services. So this looks more to the origin location. Where did the printer incur its payroll and its utilities and its inventory costs and its supply costs for providing the services it provides to its customers? The cost of performance rule and the market sourcing rule can vary depending on the type of service that we're talking about, but generally market sourcing is where your customer is. A proxy for that can be the billing address or headquarters of your customer. Cost of performance, more often than not, is really going to capture your production facility location. And in the cost of performance rules, they tend to be all or nothing states, right? You get to source the revenue for services to the state who has the highest preponderance of that costs of performance. Some states will allow you to look at your revenue as a whole, the cost of performance to generate all of the revenue for all of the services that you provide. More and more states, however, are making you segment service by service by service, or customer by customer by customer, and recalculate what was your cost to provide that one service to that one customer. So that way there is a little bit more variability. A growing trend among states as they amend and reconsider their apportionment rules is to add a specific example that covers the direct mail industry. We'll get into those states in a couple of slides. And that trend really is to capture or move towards a rule that's very similar to the rule in effect for sales tax purposes, which is to say the services you provide as printers are directly connected to printed goods that you are delivering somewhere. And in that instance, states are going to look to or require you to apply the same delivery destination rule. Let's move on to the next slide. This change and this trend is a pretty significant change for direct mail producers. As I just said, we're aligning income tax sourcing with sales tax rules, which are a nightmare to apply, as you all know. And it is going to be a challenge for similar reasons for these multi-state mail campaigns. I think even more so on the income tax side, because there's a much slower frequency in which you're preparing these returns, right? You're doing sales tax returns on a monthly basis, and income tax return just on an annual basis. And that perpetual problem of what data you have available to you or to your accountants at the time you need to prepare the return to figure out what your delivery destination spread may be. Moving on to the next slide. All right, so we're going to get into examples from some of the states. These are the states that we talked about in the recent article that we published. Florida is one of those states that seemed like it couldn't make up its mind. It uses both the cost of performance rule and the market sourcing rule. You might say, well, how does it apply to completely different rules at the same time? Well, Florida changes which rule applies based on who provides the paper. It's not uncommon, as you guys well know in your industry, that your customer may be the one who decides it has a good relationship with its paper vendor. It's going to separately purchase paper and have paper for its print job delivered to the printer or the producer. Well, if that's the case, Florida allows the printer or producer to use the cost of performance rule. It's, sourcing to the production facility largely, in sourcing the revenue that the printer receives for providing its services to that customer. On the other hand, if the printer acquires and sources the paper itself as part of its soup to nuts production, then the printer is required to use and source its revenue from its print services based on the delivery destination of the printed piece. This really creates a particularly dissonant approach in the same state. I can imagine circumstances where printers will be required to use both rules on the same return because you may have some customers that provide their own paper and others that do not. Moving on to the next state, which is Illinois. Illinois uses market-based services. However, it has a quirk to it, which should not surprise anyone, Illinois being Illinois. Illinois requires that for a company to use market sourcing, or a revenue producer, the printer, to use market sourcing, but it only allows the printer to do that if its customer has a fixed place of business. Now, for most of your customers, they're going to meet this test, right? Because you work with businesses that have a fixed location out of which they operate. That location doesn't have to be in Illinois. It just has to exist. Do they have a headquarters from which they conduct business day in, day out? If they do not, however, then Illinois requires the producer to look and source all of its revenue to the origin location, the place from which the order for the print campaign is placed. In some ways, although it is less intuitive that you have to look for where your customer has a fixed place of business, it does at least simplify rules for printers. You have one of two locations that the sourcing could be. You're not looking at the thousands of delivery destinations. Virginia, on the next slide, which we're going to get into, still uses the old school rule, the cost of performance rule. Your income as a printer is sourced to where the preponderance of direct costs. When I say preponderance, sorry, it's a lawyer word here. I just mean the most of the percentage, right? The highest percent of your income. And you source that income based on the state where that captures the highest proportion of your direct costs to provide the services. It's all or nothing. So if one state has 50.5% of your direct costs, that state gets all of the income. Virginia is also a good state for other reasons that we'll get into in a few slides, in terms of what are the other more nuanced rules that apply in apportionment. And moving on to kind of our last.
Can I just,
Oh, yeah, go ahead,
before you
Marty.
get there, so all the three states that you just described, Illinois, Virginia, and Florida, those rules apply whether the printer is operating in those states or in any other state. So the rules that we're talking about for apportionment apply across. If you have nexus with the state, they apply across the board, whether your location is in the state or not in the state. So that adds another variable to any company deciding where it's going to print, where it does business. Obviously, most of the attendees in this webinar already know where they're doing business and where they have a place of business, but it's still a variable that you should take into account.
Yeah.
Thank you.
That's a good point, Marty. And for example, just sticking with Virginia while we have it on this slide, because Virginia applies this all or nothing rule, if you're a printer who is not based in Virginia, you might have nexus there because I think Virginia does not have economic nexus, but you have nexus there maybe because you do have a remote employee, or you have a sales rep, or you have some other footprint that creates a nexus with Virginia, but your production facility is in Illinois. Let's stick with our example states, right? Under Virginia's rule, all of your direct costs, or more than 50% of your direct costs, are likely incurred in Illinois, where your production facility is. That means even though you have nexus with Virginia, you might have zero apportionment to Virginia because of how this cost of performance rules works. Zero apportionment means zero taxable income that's actually sourced to Virginia at the end of the day. Let's move on to the next slide. These are the states that give me angst and agita for direct mail producers, in large part because these are the states so far, Maine being the most recent to join the crew, that have crafted this kind of hybrid rule for the direct mail industry, which is that if the services, according to their rules, are provided in conjunction with direct mail production, and they specifically call out direct mail production and printing production, then you source your revenue from those services to the delivery destination of the direct mail. In many ways, this is trying to enforce market sourcing for these states, but it is imposing what would be the sales tax rules in the income tax context. We typically don't see crossing of lines from tax type to tax type in this way. But you can see here, these are the 5 states that you really do need to pay attention to in terms of this weird hybrid delivery destination rule for market sourcing for services. And you can see, if you have revenue that would be sourced to Massachusetts or Maine or Illinois under its rule might capture 100% of your revenue because you produced the direct mail in Illinois. And at the very same time, Massachusetts might also say, we get 5% because you mailed 5% into Massachusetts. Well, 100 plus 5 is more than 100%. You can see why we said at the outset, the way that the states apply these rules together makes it really tricky to enforce and has some quirky outcomes. I also want to call out attention to Massachusetts, and we'll wrap up more quickly on this section and move on to the next topic. But Massachusetts, as Marty pointed out in his slide on PL 86-272, is one of these aggressive states. It's in the process right now of finalizing regulations that would adopt this more aggressive interpretation of PL 86-272. And my concern is that once Massachusetts finalizes this, and it's fairly certain that they will in fact finalize this, that they will take the position that because their sourcing rule now sources services based on the delivery destination, that printer is conducting activity, conducting something more than just soliciting the sale of TPP. We now have services that are being sourced to Massachusetts because of how the sourcing rule applies. And once that sourcing rule applies in that way, projecting out with Massachusetts will then say printer based in Illinois who has no physical presence in Massachusetts of any kind now is no longer eligible for that federal protection. So definitely something for you if you have delivery destination in Massachusetts to speak through with Marty or me or your accountant. Let's move on to the last section on these apportionment rules, which is throw out, throw back, and nowhere income. Nowhere income really refers to this concept where you may have income under sourcing rules that gets geographically assigned to states where you don't have nexus or where you're not taxable. You'd think this is a good problem, right? You have nowhere income that results maybe in less than 100% of your income being subject to tax at the state level. Throw out and throw back are the state's 2 different ways of attempting to address what they conceive of as this problem of nowhere income. There are a few states that don't have either throw out or throw back. These are the great states to be involved. New York, Michigan, Virginia, and Vermont. That means that they only tax the income that actually is sourced to their state as part of their apportionment formula. we'll get into what the difference between throw out and throw back is on the next two slides, but I want you to think about, they effectively accomplish the same thing, right? Which is to increase the apportionment percentage in states that have these rules. They do so in different ways. Let's move on to the next slide and talk about throw back. Now, throw back is like the clawback provision. This is a state that says you have nowhere income in Nebraska. Great. If you fulfilled your order from our state, let's use Wisconsin as an example, right? Or Illinois as an example. If you fulfilled your order from Illinois, even if it ended up in Nebraska where you're not taxable, Illinois is going to capture those Nebraska sales and put it in the Illinois numerator. As you can see here visually, it makes the numerator bigger, which results in a bigger apportionment percentage. Moving on to the next slide. Throw out is the rule that operates almost in the inverse. It's like the tax world's version of, if I can't have you, no one can have you, right? What throw out says, and this usually only applies to intangible property and services, but what throw out says is if you have service income that ends up sourced to a state where you don't have nexus or where you're not subject to tax, then we're going to remove that revenue from the denominator of the sales factor. It makes the denominator smaller. Static number on top, smaller denominator on the bottom. We all remember third grade geometry or math. That means the percentage or the ratio ends up being bigger. Moving on to the next slide. I think this is, I'm going to turn things back over to Marty. Now that we've thrown these concepts out at you and talked about what is apportionment and why to think about it, let's talk about how to plan about it.
Thank you. Thanks, Jamie. And I won't talk about throw up income. we'll just keep it to throw back and throw out. But so the risks, I'm going to first talk about the risks are obviously you're subject to income tax in a high tax state. There's not a lot you can do about that other than to support the litigation to try and challenge this. But there is stuff you can do in terms of planning the revenue factor. Not much you can do in California because California is going to base it on sales. And unfortunately, California has what's called combined reporting, meaning that even if you have an affiliate that makes sales in California, that will all be included in the numerator of the factor. And combined reporting just means that it's like a consolidated filing for the federal tax purposes. There are some states that are separate tax filing states. Those are good states because then that gives you an opportunity to plan when we deal with the next level, which is the income tax based on in-state activity. If you have a state such as Georgia that has is not a combined state, if you plan the activities of the company properly, you can limit the tax in that state to only the entity that has nexus. It may be nexus because of sales or maybe nexus because of a physical footprint. But the critical issue is that companies do when they plan is to isolate the nexus activities in the company in one company and identify revenue for a separate company to limit the amount of tax subject to the amount of income subject to tax in separate company states. Doesn't work in New York, doesn't work in California or even Illinois, but will work in other states. Next slide, please. So one response to the California approach, it won't work probably, is to consider following Florida, Illinois, or Virginia sourcing approach, as we discussed, where it's not sourced based on destination, but could be sourced based on where performance is done, etc. Not every state has weighed in the printing industry as to which approach applies. So it's finding the proper apportionment approach in states which have not weighed in, which is the trick. Barring everything else, a company should consider its past potential liability based upon economic or physical presence, based on economic presence, and that involves the concept of VDAs. I think we've spoken about that in the sales tax concept, but a VDA it's short for voluntary disclosure agreement, and it's an opportunity to approach the state and get a waiver of penalty, sometimes interest for the past, and limit the look back period of the state. In the case of New York, you don't have to do that because of the recent case that we were involved in, where there is no liability for the period of time prior to 2024. And then in connection with in-state activity, printers traditionally have had some kind of solicitation of sales in the state. And now post-pandemic, a lot of printers still may have some remote employees. Critical thing is to make sure you limit the scope of the activities of those employees or companies or employees or representatives soliciting sales to the critical factor of soliciting the sales of tangible personal property, and to do so by guidelines that are promulgated, so that if a state ever comes calling, you can say we have these guidelines and therefore we're not subject to the tax. It may be an anomaly that something that exceeded the protection of the federal statute happened. But again, the critical thing is to plan and to determine whether or not you can fit within the straitjacket of Public Law 86-272. And if you can't, then to consider approaching the states to get a relief from back tax liability. Better to approach the states before the state comes calling than afterwards, because much more flexibility in an approach. Next slide. Again, consider applying the sourcing rules for Florida, Illinois, and Virginia for mailings to those states. It's very difficult, as you know, from a sales tax context to determine apportionment of sales tax based upon destination. Equally as difficult in an income tax context, and exposes the company to sales to potential income tax. Another mystery that another advantage that many companies don't take advantage of is if you're located in a state like Virginia and you may not have nexus in any other state, you should consider establishing nexus in another state. It's counterintuitive, but establishing nexus in another state means that the only sales that go into the numerator of the apportionment factor are sales to Virginia, sales destined to Virginia, or cost of performance in Virginia. No sales to any other state would get thrown back to Virginia, and there would not be 100% apportionment. Therefore, the bottom line is that you may save a significant amount on Virginia income tax. Same thing applies to Vermont. If your state does not have, if the state where you print or the state where you're headquartered does not have a throwback rule, that could be an opportunity for the company. And then, as I indicated on the last bullet, consider establishing nexus in a state that doesn't have a throwback or throwout rule. One other thing, for if you're a pass-through entity, while there is oftentimes a credit on an individual income tax return for taxes paid to another state against the current state's income tax, there are two real significant limitations on that. Limitation one is if the tax rate in the other states, such as in California, is greater than the home state tax rate, you will be paying tax at the on income at the much higher rate. The second very significant amount is that California, for example, has a tax on subchapter S income, and that tax is fairly steep. It's 1.5% of the income of the sales sourced or the income sourced to California. That can be a very significant tax. Limited liability company tax, there is a tax on limited liability companies. It's a little bit lower, but still can, amount up to $20,000, I think. So not a free pass by having a pass-through entity, and so one should carefully analyze their own profile to determine what is best for them. Hard to generalize in this context when we talk about planning opportunities. It's really should be done on a case-by-case basis. And with that, I'll turn it over to you, Jamie, to conclude our
Wrap us up.
formal presentation and on to Q's and A's.
Sure. And I'll make one last addition to the point that Marty was making there about the challenges with pass-through entities. If you are operating as a pass-through entity and the entity itself is subject to one of those taxes, like the 1.5% in California, or you've taken the pass-through entity elective tax in a state that has one of these options. Not every state recognizes that credit for a tax that the entity itself pays against your personal income tax return, taking the position that you as an individual and your company as a pass-through entity are two different taxpayers. And so states are not required to give that offsetting credit. I know our home-based state of Maine is one of those states. Virginia used to be as well. So that is a challenge just to be mindful of if that is the entity structure of your business. So to wrap things up, and I think we have about 10 minutes for questions after this, it's really important to understand what are your sourcing obligations, because they do vary state by state. And in your industry where you are selling products, right? You're selling that printed piece. And so many of you are also providing services on top of that. Your sourcing obligations are going to vary depending on the genesis of your revenue, and may operate kind of at dissonance or in tension with one another state by state by state. It is important to track where your mail is delivered. We recognize, you've heard us talk multiple times about the challenge of that on the sales tax side, given what data limitations you have, how long you're able to access and keep specific data about your like mailing lists or the delivery destination. But it is important to keep what data you can, even if that's just the zip codes, at a base level, because you're going to need them for helping you address what your sourcing obligations will be once you start doing business across state lines in more than one state. And lastly, you're going to monitor legal developments. As we said, these states are moving toward single sales factor and moving toward market sourcing, and they're amending their nexus and apportionment regulations to add nuance that varies by industry. Do these legal developments happen on the same frequency in the sales tax world? No, again, because income taxes are filed only once a year. However, every year there are developments. Our team tracks it. If you have questions, absolutely reach out and ask us if something has changed in your industry from an income tax perspective that's important for you to know about. And on that note, I think we have time for questions. We're going to open the floor. You have our contact information here, and our bios and the slides for today are in the chat thread. Thanks, Michelle, for uploading our article as well that we published a couple of weeks ago that goes into these apportionment rules in a little bit more detail.
Yes, and I'll tell you, having spent my number of years working on postal regulations, I feel absolutely humbled when you guys start talking about tax regulations, which is like the third level of postgraduate understanding compared to the elementary class of DMM rules. Oh my gosh. Well, no, I don't see anything in the Q&A right now or the chat box. I would remind everybody who's listening though that our friends here at Brandon Isaacson are the folks that we've been working with for years, since I had hair and Marty had dark hair, and Jamie was in grade school, and we were they've been a constant source of excellent advice for us on tax things, on a variety of things that are relevant to our subscribers. So if you do have an issue that you want to discuss, please feel free to reach out to them. They do have the contact information is in the chat, and I would urge you to download it. I still don't see anything, so I have a question. Because I was
Sure.
trying to pay attention, I went through the bios, and I have to ask Marty, what is the order of the quaff? Of which,
Or
of which you
Well,
are a member.
first
I don't need a quaff, so
I think there are other law schools that provide that order of the coif. It's the top 10% of the law school class. I went to the University of Illinois Law School, so despite what Jamie says about the great state of Illinois, it is a good state, because they did recognize me as on the order of the coif for
so
that.
they've got to
That
be
may
okay
be the
then.
only reason, but it is a quirky state. It can be a quirky state, and the tax department in Illinois can be quite aggressive. You know, if we rank tax departments, California is probably the most aggressive. They have actually two separate agencies, one that deals with the income tax and another one that deals with the sales tax. And New York can be aggressive, but you know, contrary to the reputation, not quite as steadfast or stubborn as the state of Illinois or even California. Our experience, at least, litigating cases with California is much different than litigating cases with New York, where it's, believe it or not, a much more civil way of dealing with things in New York than in California. Texas can be a very aggressive state, doesn't have an income tax, does have a fairly oppressive gross receipts tax, and is very aggressive on the sales tax side. Washington is also a fairly aggressive state.
Well,
So
as Jamie was saying, you got 50 states, 50 different flavors, 50 different
you
ways of
do.
doing things.
You really do.
And heaven
Mhm.
forbid we do two things the same way.
I know.
Yeah,
That's
you
it.
know, it's both a disadvantage and an advantage to industry, you know, and
You-
what
you get-
what you
it's like-
always do, what good practitioners do, is try to take advantage of the flaws in the system, but
you
at the
shop.
same time, protecting the companies from
Right.
some of the overreach.
That's why Delaware is what Delaware is in some ways. Very popular corporations. So
Yeah.
I think with all that in mind, we have come just about on an hour here. And I know that Marty's computer battery may be giving him fits. So before we hold up anybody any further here, I just want to thank everyone for participating today. It's been a really, really good webinar, and as they indicated, as our friends here indicated, they will be providing updates regularly. Whenever I can beat Marty over the head and shoulders and get a nice article out of him. He writes a nice article for us about what's going on in tax and other kinds of laws, and keeps us all straight about that. So with all that in mind, I want to thank everybody for calling in today, and thank especially Marty and Jamie. Marty, you enjoy your time there and with
Yeah,
family. And Jamie, I want a blueberry pie out of you.
I will send you a blueberry pie, Leo. I
So
think I owe
thank you,
one at
Leo
this
and
point.
Michelle, and thank you for all participants for letting us present and listening to our war stories for an hour and not falling asleep.
No,
It's
but
good
everybody
news.
paid attention. Thanks again,
Excellent.
folks.
Thank
Until our
you.
next webinar on August 7th, take care. Stay out of the hot sun. Bye-bye.
Thank you. Bye.
Bye-bye.